Well, there's been a lot of talk lately about whether gold and silver just ran out of steam after that sudden reversal, and whether the newest inflation shock and the latest move out of India have changed the entire price outlook. So, in this video, we're going to separate by piece, and you are going to walk away with a much clearer view of what actually matters now. Today is Monday, May 18th in New York, and comment below what day and date you're watching from. And if you value my content, support the channel by subscribing and commenting, Our John AG. So let's start with the part that hit the market first. Inflation came in hotter than traders wanted, and that immediately changed the mood around gold and silver. Based on recently published numbers, consumer inflation accelerated again, producer inflation moved even more aggressively, and the market quickly started asking whether the Federal Reserve might have to stay tighter for longer. Now, on the surface, that sounds simple. Hotter inflation should be good for metals, because gold and silver are supposed to protect purchasing power. But markets do not always move in the straight line people expect. In the first reaction, traders often focus less on the inflation itself and more on what the central bank might do about it. If hotter prices mean fewer rate cuts, delayed rate cuts, or even renewed concern about higher rates, metals can get hit before the longer-term inflation argument has time to reassert itself. That is exactly why the recent pullback does not automatically mean the larger metals thesis is broken. It means the market had a sudden policy scare. Gold and silver were forced to absorb a tougher interest rate narrative, and they did what risk-sensitive assets often do when that happens. But that is not the same as saying the story is over. It is saying the path got more complicated. And there is an important distinction here. A hot inflation report is not automatically bullish for metals in the next 24 hours. Sometimes it is bearish first, because yields rise and the dollar firms. Later, if inflation stays sticky while policymakers struggle to get ahead of it, that same inflation problem can become supported for metals again. And if you skip that step, you end up reacting to every headline instead of understanding the setup. From recent market updates, the Federal Reserve's latest official decision was still to hold its target range steady rather than deliver a fresh hike. That matters. The market may argue about what comes next, but the policy action on the table has been hesitation, not a new tightening campaign. So when people say metals are finished because inflation ran hot, that is too fast. The data were uncomfortable, yes. The reaction was real, yes. But the policy story is still unresolved. Now let's slow this down one more level, because this is where people get tangled up. Inflation is one side of the equation. Rates are the other. What metals investors care about is not just whether rates are high in isolation. They care about whether the return on cash and bonds is clearly outrunning the loss of purchasing power. If inflation is pushing higher while policy rates are only sitting in the mid-3 range, then the real return picture becomes less comforting than it looks at first glance. I want to be careful with that point. It is too aggressive to declare that every version of real rates has suddenly collapsed. That is not the cleanest way to say it. But on a simple backward-looking basis, inflation and short-term policy rates are now close enough that the protection investors thought they had from cash and short-duration bonds does not look nearly as comfortable as it did when inflation was cooling. That matters for gold. And eventually, it can matter for silver too. There is another layer that the market cannot ignore, and that is the federal debt backdrop. According to the latest publicly available figures, total United States debt is now sitting just shy of the 40 trillion mark. That does not mean an immediate crisis is guaranteed. It does mean higher borrowing costs become harder to shrug off. When debt is that large, the difference between manageable refinancing and painful refinancing is not theoretical. It is a live pressure point. And this is where metals investors need to think in terms of tension, not slogans. If inflation is sticky, policymakers do not have an easy reason to cut. If debt costs rise, policymakers also do not love the idea of keeping rates elevated forever. Those forces pull in opposite directions. That does not produce a clean, calm environment. It produces a messy one. And historically, messy monetary environments are exactly when gold tends to stay relevant. Now, silver is related, but it is not identical. Gold usually reacts first when the market is worried about currency credibility, reserves, policy confusion, or broad financial stress. Silver can follow, and sometimes it follows with far more violence, but it also carries more industrial sensitivity and more volatility. That means silver can feel euphoric on a strong day and disappointing on a weak day, even while the longer trend has not been decided. That is why I would challenge one easy assumption floating around right now. A sharp silver bounce by itself does not prove that the whole metals complex has fully resumed an uninterrupted breakout. It can be encouraging, it can be meaningful, but gold confirmation still matters. Dollar pressure still matters. Bond market behavior still matters. If you only look at silver in isolation, you can miss the larger signal. And while silver's longer-term case remains interesting, the demand picture is not perfectly one-directional either. Recent industry research has pointed to some cooling in industrial silver use after several strong years, even while investment interest remains firm and supply concerns have not vanished. Silver can still be bullish without every single demand line rising at the same time. Markets are more nuanced than that. So, the first big development is this. Inflation made the metals trade more volatile, not automatically less valid. It raised the bar for an immediate breakout. It strengthened the argument that investors need to watch the next round of data closely. And it reminded everybody that gold and silver can remain attractive over the medium term while still getting punished in the short term when the rate narrative suddenly shifts. Now let's move to the second thing, because this is where the story became much more confusing than it needed to be. There was a wave of chatter suggesting India had suddenly slammed gold and silver with a major duty shock. That version spread fast because it sounded dramatic. It also sounded like the kind of move that could crush demand overnight. But when you take it apart carefully, the picture is not that simple. What is confirmed is that India's Prime Minister publicly urged citizens to reduce gold buying for a period of time as the country faced pressure tied to foreign exchange concerns. It matters because India is one of the most important physical precious metals markets in the world. When officials there speak about gold behavior, the market listens. But the more explosive claim that India had broadly raised gold and silver import duties in the way many people repeated it is not the clean, confirmed story. In fact, there was public pushback from a government source saying there were no plans for that duty increase. So right away, we need to separate the verified development from the viral interpretation. The verified development is not a blanket import duty shock. The verified development is policy pressure, public messaging, and then a separate direct move affecting silver imports. And that silver move matters. India issued a new restriction covering certain forms of silver imports, shifting them from a freer entry category into a more controlled one. That means the import path becomes more administrative, more selective, and potentially slower. In a market already sensitive to physical availability and regional premiums, even that kind of policy friction can affect behavior. Now, think about what that actually changes. If you are a jeweler, a fabricator, or a bullion participant relying on imported silver, policy friction can alter timing. Orders may be delayed, inventory planning may get more cautious, premiums can become less predictable. Local buyers may wait, or they may rush, depending on what they think comes next. None of that translates neatly into one simple direction for global silver prices. There is also a related detail that makes the India story more balanced than the dramatic version online. Indian banks had recently resumed some bullion imports after a separate customs-related issue had disrupted shipments. So the country was not moving in one clean direction from open market to everything shut. It was moving through a messy adjustment period, with officials trying to protect the currency, importers trying to keep flows moving, and the metals market trying to price all of it in real time. That brings us to the actual precious metals implication. For gold, public appeals to reduce buying can cool sentiment at the margin, especially among price-sensitive households. If the rupee is under pressure and local prices rise, some purchases may be postponed. That is a real near-term headwind. It should not be dismissed. If demand softens during a period when global markets are already digesting hotter inflation and firmer yields, the consolidation phase can last longer. For silver, the read is more complicated. Restrictions on certain imports can weigh on immediate trade flows, but silver also occupies a different role than gold in India. It touches jewelry, investment, and industrial uses. That means demand is not driven by one single buyer group. If policy friction reduces some flows, while currency anxiety increases the appeal of hard assets, the net effect can shift quickly. It is not a one-line bearish conclusion. And here's the counterpoint people need to hear. Not every policy attempt to suppress precious metals demand succeeds in the way policymakers hope. When citizens worry about currency weakness, they often become more attracted to assets that sit outside that currency. That does not guarantee a buying surge. But it does mean pressure campaigns can create mixed results. Some demand may fade, some demand may simply get delayed. Some demand may even intensify if households feel the local currency story is deteriorating. So if you are trying to understand India's effect on gold and silver, watch two things first. Watch the rupee. India is highly sensitive to energy costs, and higher oil pressure can worsen the external balance while also weighing on the currency. If those pressures ease, the urgency behind anti-gold messaging may soften. If those pressures worsen, the appetite for hard assets may become harder to control. Now let's connect the two big developments, because together they tell a cleaner story than either one alone. In the United States, hotter inflation made rate expectations less friendly for metals in the short run. In India, policy pressure and silver import controls created a second source of uncertainty for physical demand. That combination was enough to shake confidence. It was enough to make people wonder whether the whole move had failed. But once again, that is not the same as saying the larger case for metals has disappeared. It means the market has new obstacles to digest. It means the next advance, if it comes, may need more confirmation. Gold may need to prove itself first. Silver may need to work through policy noise and its own volatility. And investors may need to accept that the road toward higher prices, if it continues, is going to be uneven. If you're successful, share your success story in the comments so others can stay motivated. Let me make this practical. The inflation shock matters because it can delay easier monetary policy. The India story matters because it can temporarily distort physical demand patterns. But neither development erases the larger conversation about currency confidence, debt pressure, and the appeal of scarce real assets when policymakers face uncomfortable trade-offs. That does not mean you chase every dip blindly. It does not mean every red candle is a gift. And it definitely does not mean risk disappears just because the long-term thesis sounds attractive. What it means is that a disciplined investor separates a broken thesis from a noisy correction. Those are not the same thing. One deserves a strategy change, the other deserves patience and sharper attention. From recent market updates, the most important near-term signals now are fairly clear. Watch whether inflation stays elevated or begins cooling again. Watch whether Treasury yields keep pressing higher or stabilize. Watch whether gold can regain leadership after the pullback. Watch whether silver reacts more to physical policy headlines or broader macro conditions. And watch whether India's measures turn into a lasting demand drag or a short-lived disruption. I also want to emphasize something that gets lost every time markets move fast. Gold and silver do not need a perfect environment to rise. They often rise in environments that look confusing in the moment and obvious only in hindsight. So, putting it all together, the two important things that just happened are not random noise. First, inflation heated back up enough to rattle the rate story and pressure metals in the short term. Second, India introduced a real policy complication around precious metals, especially silver imports, but not in the oversimplified way many people repeated. Those developments can slow the advance. They can create sharp swings, but they do not automatically cancel the broader bull case. Do not go from absolute confidence to total despair because of one rough stretch. Do not treat every viral claim as settled fact, and do not confuse uncertainty with collapse. This market is still giving mixed signals, and mixed signals require discipline. Do you think the bigger driver for metals from here will be United States inflation pressure or India's policy shift? And one last thing, this is educational commentary, not personal financial advice. I'm sharing how I see the moving pieces, not telling you what to buy, sell, or hold.